Hello, Newchip community. My name is Yi, and I am a venture fellow at Newchip. As always, thank you for participating in our May demo week and choosing this particular panel discussion to watch. Today, we want to talk about early stage investing, an important topic for our investors and founders. When I was leading my pre-seed mastermind sessions at Newchip, a lot of founders would ask me, which investment instruments should I choose for my company? This is a very good question because early stage investing is critical for startups. If set up correctly, founders will save time and energy for future negotiations. Therefore, I invited two experts here today to help us understand, explore the options our early stage founders have. First, let's do some introductions. Kerry, would you like to take the lead?
Sure, thank you. And thanks so much for having me here today. I'm a big fan of Newchip. I'm a current mentor. I've worked with 5 startups in the program and have enjoyed every single minute of it. My entire career has been based in the capital markets and financial services. I have both my undergraduate and graduate degrees in finance, and I'm a Chartered Financial Analyst. So that's a professional designation that people take 3 to 4 years to get through a series of examinations. I worked in my early career at Nasdaq stock market. I was there for about 7 years before being recruited to work at Bank of America, where I did interest rate, derivative structuring, and balance sheet rearrangement for their Fortune 1000 type companies. And having had a lot of derivatives experience, I then moved over into alternative investments, initially working for a hedge fund that had a very concentrated portfolio of derivative structures like variance swaps and volatility swaps in Asian securities, specifically convertible debt instruments. And that's where I really got my first understanding of how startups use convertible notes. This was part of that process. From there, I moved on to a private equity firm where I was the chief operating officer, and also got interested and involved in that family office's venture capital investing. More recently, I founded with my 2 co-partners, Jay and Sparky, a firm called Supercritical. And what Supercritical does is it works with startups that are specifically focused on the cannabis, hemp, CBD industry. And we do everything from advisory to capital structure recommendations, working with them in terms of the pitch, the presentation, the fundraising. And when I'm not doing all of that, I have 4 kids that I raise, and really, probably that's my proudest accomplishment, my children. I also do a lot of nonprofit board service, and I serve on 2 private company boards.
Awesome, impressive. Thank you so much, Kerry. Next, we have Rajesh. Please go ahead.
Hi, thank you again for inviting me to this. I'm Rajesh Gopi. I'm the co-founder of a fintech company called 212. We're based in Austin, Texas. We build products basically focused on startup founders. We see the challenges that founders have with respect to how they go about trying to value the company, how they try to raise capital, how they interact with investors, their cap table, their exit modeling, the liquidation preferences, trying to understand the term sheet. So we basically build a one-stop shop where they can come in and get all these different features available under a single umbrella. So that's what we're doing at 212. And prior to 212, I've been at 3 different startups. I've also been at multiple Fortune 500 or Fortune 100 companies. Been writing software primarily for maybe 25 plus years. And I have an MBA from UT Austin. So it's like a mix of operations, software development, product management, building companies. So that's my background, and excited to be part of this panel.
Awesome. Thank you, guys. Really great intros from you. Great. Now, let's get started. Let's kick into the topics today. Let's get started with some basic things that early stage founders should be aware of, because the companies are so early at their ventures. There are only certain types of investor they can pursue. The most common sentence that founders hear during the investor meeting is, you are too early for us. So what kind of investors can be qualified as early stage investor? And also maybe how can we find them as well? Either of you can start first.
Sure. Very, very good point. And I think the most critical takeaway from there is for founders to really do their homework and research and identify who are the investors that are coming in at seed or pre-seed stage, and also if they're investing in your industry or sector. One of the best ways that I've found to learn about who's investing in what you're doing is to read the blogs, things like Financial Revolutionists or Chicago Inno or any of the Innos. They're always great. And understand who's getting funded, by whom they're getting funded, the amounts, in what stage. So any of those blogs will say whether it was a seed investment, Series A, Series B. So you have a sense of the scope and the magnitude of the investment that those VCs are making.
Awesome. Yes, I remember I read a lot of articles from Crunchbase and Medium.com as well. A lot of venture capitalists actually will publish their articles on those blogs, which is a good way to reach out to and find their information. Yes, thank you, Kerry. Rajesh?
Yes, so the way I think about this is think from an investor perspective. So the investors, let's say they're deploying $100,000, so they can go buy real estate, they can go buy crypto, buy securities in the public market, or invest in your startup. And the chances of them getting most of the money back is pretty much 100% if they go to any of the other places. But the probability of them, that 100,000 becoming zero is very high when they invest in an early stage startup. So if you as a founder put your mindset in terms of what you can do to help your investors, then it'll kind of change a lot of things in your favor. So things like, okay, do you have a product? How quickly can you get to revenue? How will that investment grow? So if you start thinking along those terms, then it makes it easy for you to have conversations to get to a point where you can successfully go raise capital. It is true that initially when you start off, you're just one or two people trying to figure out if this is a viable business. Your best bet is to support it yourself or find friends and family who basically believes in you as a founder to be successful. That is the easiest place where you can get capital. There are some funds that I know of that would do some sort of a founder metrics. They look for the integrity of the founder, the background of the founder, and they look at some qualitative metrics to determine if it's a worthwhile investment. So they might write small checks, and then once you prove out that you are able to execute your vision, then they come in with larger checks as a follow-on. So and one thing you could do is like if you Google for VC list, no introduction needed. There is a person who maintains an airtable of different investors and when they last invested in, how much they invested and things, and different industry and sectors they kind of focus on. So those are the different areas that a startup can go to go find some initial capital. The other thing that I can recommend is join a program like Newchip, where going through the program basically reduces the risk for an investor to invest in a deal, because they know that, okay, it's not a total newbie that they're giving money to, but somebody who's gone through a process and spoken to different mentors and have a better shot of being successful. So those are my 2 cents there.
Yes. That's very nice advice from you, Rajesh. Yes, sometimes a lot of networking, LinkedIn reach out and just have that list of all the investors that you want to talk to can be beneficial. We are looking to angel investors, sometimes high net worth individual, friends and family, and also early stage fund that invest in early stage companies as well. So we do have some good lists out there. Now, let's assume that we find some investors, people who are interested. Now, as we know, the 3 most commonly used securities for early startups, SAFE, KISS, and Convertible Note. SAFE and KISS are definitely popular in the US area, and more international investors start to adopt them as well. However, what are the similarities and what are the differences? Kerry, do you want to start?
Sure. When we talk about a KISS and a SAFE, those are just acronyms for vehicles by which one can invest into a company. And the SAFE is a bit older, started in 2013 through Y Combinator, and KISS came out a year later with both an equity version and a debt version from 500 startups. That was in 2014. The differences are very nuanced. SAFE will not have a maturity. It will not have an interest rate. And that's the primary difference between a SAFE and a convertible note. It also will automatically convert to preferred stock once a certain milestone has been met, which typically is raising your first round. And that would be for a specific amount. So say $1 million. Some say that the SAFE is a bit more startup friendly, but that's not to say one is good and one is bad. They're just different. And then when you bring the convertible note into the conversation, for me and the clients with whom I work, we generally do go that route because most of them are early stage. They don't have a real valuation yet. They have a collection of milestones that they're working towards. And there are a number of different valuation methods that we employ and kind of aggregate them to get what generally might be the valuation. But if you use a convertible note, it gives you a way to delay that valuation while still bringing money into your enterprise and being able to develop goodwill and good connections with those initial creditors that are going to be lending you the money. And at the termination of that, because the convertible note will have an interest rate stated, it's not paid during that time, but it is accrued and put towards the number of shares that you would get eventually when it does convert. It is a way that keeps things simple and organized, keeps your cap table clean.
Yes. Thank you, Kerry. Rajesh, what's your take on this?
So I've seen only one KISS amongst my customers because that particular company went through 500 Startup Accelerator program. The way I think about it is there are two extremes. One is very founder friendly, which I call it the SAFE. And the other is more investor friendly, which in my opinion is a convertible note. From the advantage for founders to use a SAFE instrument is because it is already created by a law firm. There are just two fields that they need to really care for. One is the valuation, the other is discount, depending on the type. And that's it. So like when we raised capital at 212, we just downloaded the YC's note, the SAFE document, fill in the numbers, and we're done. We didn't have to involve our lawyers. It just happened. But typically with the convertible note, there will be a lot more protective provisions that are given to the investor that you probably want your law firm to really pay attention to what those different things are, make sure you understand it. So that's how I look about in terms of these two documents. And then KISS is something like Kerry mentioned that and came out in 2014, if I remember correctly. But the challenge with KISS is that it has got too many variables in it. So they talk about like a 2x liquidation preference as a default. There is a maturity date. There is a most favored nation clause that gives investor better terms depending on how eventually they run a priced event. So there are many pieces to a KISS document that if a founder is not careful and don't completely understand what these things would mean, they're setting themselves for a lot of trouble in the future. So to me, the most important thing is, okay, just make sure you understand what these different things mean. Try to model them out. Plan out different scenarios. Okay, if you're actually doing a convertible note, and what if you have a price down at this range, or if you have a price down at some other range, or if it's a KISS document, or if it's a SAFE document. So make sure you plan it out and then decide what terms you like. What instrument that you want to use, and so on. The other piece I can also mention is that a lot of the investors, they don't prefer SAFEs or KISS, mainly because traditionally the convertible notes have been in existence for many years now. Like, so it's been there since I think 1900s. So there's a lot of case precedents for a convertible note. So if there is a litigation, it is clearly understood how the law will interpret the convertible note. But SAFE is pretty nuanced. It has a lot of case precedents in the Bay Area, maybe in Austin, maybe in Dallas, Houston. But if you go outside of these major metros, investors may not be friendly to SAFE notes. So those are the different aspects I can think of that, in addition to everything that Kerry mentioned.
Yes. Thank you, Rajesh. Both of you touch points on some of the terms that we are going to talk about next. But yes, because I do advise some of the international companies, and we do have a lot of international companies at Newchip. They all talk to us and say, I've never heard of SAFE, and our investors don't feel comfortable doing SAFE. What should we do? But I believe it's getting more and more popular because SAFE and KISS are so funder friendly. So now let's go over some basic terms of our early stage investing instruments. We already heard Kerry mentioned interest rate, valuation, and then Rajesh mentioned a lot of the most favored nation clause, which is a very popular clause for investors right now. What do those mean, and what are the no more situations or range, and what are not? Maybe we just touch point on some of the in terms that you feel comfortable talking about. Kerry, would you like to go ahead?
Definitely, I will. And I want to start by saying that we are so fortunate today to be able to have instant access to so much education around finance, capital markets, deal structuring. So if there's anything that you don't understand, there's a wealth of knowledge at the Newchip site, but also through so many of these different organizations that we talked about, like Y Combinator's startup, 500 startups. The information's out there. So if you don't know it today, don't worry, you can find it very easily. And you can always connect with us through Newchip too, if you have additional questions. But we'll talk about we'll start with the convertible note, because that is the oldest. That's something that is very mature. And there are a couple of components about that all startups should know. And the first would be the maturity date and the interest rate. These are two items that differentiate it from a SAFE, because that agreement does not include a maturity date or an interest rate. The maturity date simply is the term of duration that loan is stated. For most startups, it's going to be between 18 and 24 months, because it is highly likely that during that period, the startup is going to advance and move on to its next round of funding, like its first priced round. That if it needs to go beyond that time period, you can get your investors to agree with you, hopefully, to extend the term if you're not quite able to do the round within that maturity date. But generally speaking, at the max, you would go out 36 months on that. The second part of that, the interest rate, is simply the interest rate expressed in an annual amount, and it's compounded annually as well. And that's important to note, because that compounded annual interest gets added on to the principal due to the investor at the termination, and will be used when you convert into shares. So you'll be getting a little bit more shares because of that accrued interest. It varies. So I work primarily in the cannabis industry, because it in the US is federally illegal still. The interest rates tend to be a bit higher, but you'll see them anywhere between 5 and 10%. That's the average that I've seen on most of the notes that I've been working with. Interest rates are not heavily negotiated. They are generally just stated, and if the investor wants to subscribe, the investor will. If not, perhaps move on to another deal, because there are plenty. The other parts of that are very important are the discount rate and the valuation cap. The discount rate is a sweetener that's added to that note to try and get the investor to come in. And what it means simply is it's going to give you a discount on the share price in the conversion process. So essentially, you'll be buying those shares at a lower price compared with where they would normally be priced in that round. And then the other term about that I want to talk about was the valuation cap. Because valuation is a risk that the investor faces when it goes in, and especially as we said earlier, when you're doing a convertible note, you haven't done a priced round yet, and you don't have the formal valuation. So the investor is at some risk of dilution. Generally, a higher valuation means that the note holder would get a smaller percentage of ownership in the startup. So to help mitigate that risk, they generally put a valuation cap into the terms of the convertible note. And when that conversion occurs, that conversion calculation will use the lower valuation cap defined in the note terms to calculate that conversion discount percentage. And that results in the note holder converting the convertible note, it gets a little tricky to say that, into more shares of the first round, the first raise. And that results in less dilution for the note holder.
Yes, yes. Very helpful. Thank you so much, Kerry. Rajesh, do you have any things to add to that?
Yeah, I think Kerry pretty much nailed all the big terms. The other thing I can talk about is things like the liquidation preference, which is part of the KISS document. If anybody ends up signing up with that, I hope not. The idea there is, as an investor, so the KISS document was created to be very favorable, at least to protect the investors. So not from a favorable standpoint, but more of a protection for the investors. And it's again negotiable. So if a startup founder is being shown a KISS document is like a superset of everything that SAFE considers. The piece that you probably want to negotiate is your liquidation preference. What that means is, if I'm an investor and I invest $1 million, the default on a KISS document is a 2x multiplier. So what that means is, if the company exits for $2 million, I as an investor gets the entire $2 million, and the common shareholders get zero. So that is one piece that you can negotiate on. The second piece is the most favored nation clause. So what that means is, if I make an investment and there's a maturity period of 18 months with the valuation cap, so the 18th month we convert at the valuation cap. But for whatever reason, the company does a price round, I don't know, a few months later, but it is below the conversion price, then the MFN clause basically gets me the better deal of the lower valuation that has happened after my note or KISS converts. And like from a KISS standpoint, there's also the notion of the majority stakeholder. So I think the default is $50,000. So if I'm a $50,000 investor and above, then I'm considered a major shareholder, and I get certain preferential treatment into your future rounds. And there's also like a 1x participation preferred. What that means is, like in the future round, I can maintain my ownership percentage by continuing to make additional investment and maintain my equity percentage. So those are some of the nuances. That's one of the reasons why I try to dissuade some of the founders from using a KISS statement, because when you raise capital in a KISS document, you're not paying attention to a lot of the other factors that would eventually come into play. So you're not able to kind of conceive or perceive what that future looks like. So it gets much more complex if you're not already savvy with those instruments. So my preference to founders is either use a SAFE document or a convertible document, because things are much more cleaner and clearer when you pick either of those documents. So that's my take on those.
Yes. Thank you so much, Rajesh. Very helpful knowledge from both of you. Actually, I do have a question from all the founders I've been talking to, because recently I do have a couple founders coming to me talking about trenched investing, which is they call it milestone-based investing. Essentially is, for example, the investors say, I'm going to invest in you with $500,000, but I'm going to separate them into 2 or 3 things, and then based on milestones, maybe based on the revenue that you are going to achieve or certain round number or anything, but they try to change to certain based on milestones. I don't know if it's normal, but what's your take on this? Feel free to jump in.
I can give 2 examples. So there is one fund that basically starts off with a 5K investment, and that's basically okay. They do some qualitative analysis of startups because it's super early stage, and the fund basically throws 5K into maybe say 20 startups, right? And then they try to monitor what this company does over the period of next 4 or 5 months. And depending on which of these companies are hitting certain milestones, they would then start adding another $25,000 or $50,000. So they keep adding onto that. And we are a good example, like 212. So one of our investors basically said, okay, I'll give you the first 10K, show me the progress. And once we start hitting milestones, so she basically came in and added more capital. And she's one of the largest stakeholders in 212 right now. So that's one example. I've seen another example where the company, the founder basically negotiated with the investor saying, okay, I will call on $1 million, but I want to break that million into 3 chunks. And it depends on when I hit these milestones. And depending on the milestones, it was up to the founder to decide, okay, if they can sustain from revenue or take additional equity and dilute themselves. So I've seen 2 scenarios where milestone-based investment is happening. So again, it's totally up to the negotiations between the investor and the founders. Now, I don't know how it plays from an investor standpoint. When you think about a VC math, VCs have certain requirements that they want to hit with respect to how their ROI looks like. So it's again like it needs to be carefully choreographed between the investor and the founders on how that plays out. And I guess one last example that I've seen is an investor's term sheet basically had the milestone-based anti-dilution clause. So what they meant there was, okay, if so I as an investor, I'm investing $1 million in you, but if you don't show me these milestones being hit in the next 12 months or so, then my shares will double or triple or whatever that number is. So there are also certain trigger points that happen based on milestones. So those are 3 examples I've seen happen amongst my customers.
Yes. Thank you, Rajesh. Kerry, anything add to that?
Yeah, so at Supercritical, we have seen this as well as proposals. We have not had any clients that actually have priced it that way based on that type of model. But in addition to what Rajesh said, I will share that generally we go through milestones and answer yes, no to them and kind of assign a value to each yes to get to the pre-money valuation. And then once you're there and you advance and continue to achieve more milestones, investors will come in at each of those with additional investments. So I'm thinking I'll share maybe some of the top 10 factors that I think would be appropriate milestones for founders to think about in terms of advancing the raise. And the first is the investors do like to see market size that exceeds $500 million US, and that the business model scales well and that the founders have shown their ability to continue to scale as they're growing. Another milestone that immediately gets credit from an investor perspective is if the founders have had previous exits or if they have had previous startup experience or they have experience working in venture capital. Another milestone is when you convert from doing it on a part-time basis or in the evening basis to when you have one or more founders working full-time on the venture. They'll continue to invest it there. Another is when you have your minimum viable product done and it's out there, or that customer development has been well advanced. After that, it would be the business model has been validated by paying customers, so that you're actually bringing revenue in the door through customers that continue to want it, and you can demonstrate that your product or service is repeatable and sustainable. The next would be that significant industry partnerships have been signed. So whether you're doing a collaboration with someone, or you've got a JV going, or you have some type of distribution partnership that's well in advance, that will continue you to get additional funding. Another would be that your execution roadmap has been fully vetted and you're sticking to it, so that if you know where you want to be in 6 months, 12 months, 18 months from now, and previously you've demonstrated you've hit those markers, they'll continue to invest for that. Another big one would be that you have IP or you have patents pending, or that you have them already, and that you're able to defend your patents, because we all know patents not worth anything if you can't defend it and demonstrate that you actually do have that proprietary technology. And the last would be a real milestone, is that the competitive environment in which you're currently operating is favorable for your business in that industry or sector.
Awesome. That's very helpful. Thank you so much, Kerry and Rajesh, for sharing. Now let's look into some scenarios from your experience. What challenges and issues that our early stage founders can run into when evaluating term sheets? In other words, what is the good, the bad, and I guess the suicidal? What should be careful with? So yes, Kerry, do you want to get started?
Yes. I would say the most helpful thing that a founder can do is to have intellectual humility and just understand that you're not going to know everything. None of us knows everything, and that it is critically important to be curious and ask questions. So if there's something that you don't understand, if there's a term that an investor is bringing or is asking and you're not clear on it, make sure you understand specifically what it means. I also strongly encourage everyone to work with an attorney. There are many great startup attorneys out there, or firms that will offer packages. So, and Newchip can introduce those relationships as well. But anywhere from $1,500 to about $5,000 US can get you all of the startup documentation that you need, and it can get you the overview of any of these specific agreements that you're going to need to execute in order to raise the capital. So make sure you understand that. If you're legally binding yourself to an arrangement or a relationship, get it looked at by a lawyer and make sure you understand exactly what you're agreeing to.
Yes, that's a good advice, because at Newchip, we always tell founders to not save money on legal expense.
Yes.
And especially right now, with a lot of lawyers in the market, a lot of lawyers actually focus on startups. So they offer flexible pricing plan for startups as well to help with their cash flow. So it is at Newchip, like Kerry mentioned, we do have some connections and firms that we can introduce you to, not limited to the investment instrument, but also cap table and also a lot of other patent filing. So yes, Rajesh, what's your take on this?
So I have seen term sheets that are like 3-page and all the way through 50 pages. So it all depends on how much your lawyer wants to squeeze you. But the most important, there are really two really important things in a term sheet. One is the control provisions. The other is the economic provisions. You'll see a lot of other nonsense creep into this, but they're really not significant. So if you are arguing with your investor about terms that are not directly translated to either control or economics, then you're wasting your time. So from a control standpoint, it would be the board composition. It would be the protective provisions. So those are the pieces that lets them control what happens within the company. The economic part would be your valuation of the company, your liquidation preferences, anti-dilution clauses. So those are all the economics part, including option pool. That's also very significant. So so those are the two pieces that you need to watch it for. And from a good standpoint, you are, as a founder, you're better off having more than one term sheet. So you really want to kind of compare the term sheet. So you're really starting a negotiations with multiple VCs to lead your round. Make sure you don't tell each other who they are. So otherwise they will kind of negotiate amongst each other and then kind of screw you over. Approach different VCs to lead your term sheet separately. Make sure each of them kind of know that you are looking at multiple options. So and then pick the one that makes sense for you. So it doesn't mean that whatever you get, whoever offers you the best valuation is the one that you should be going with. You really want to think think of your VCs as a long-term relationship. It's like I think the adage is you can marry. You can divorce your spouse, but you can never divorce your VC. So they're with your company through until the company exits. So make sure you pick the right VC who can help your company grow. So that's one piece. And then from a bad standpoint, so there are things that you need to watch out for, like the liquidation preference. So I keep bringing that up all the time because most of the founders that I run into, they don't understand the significance of certain terms they agree to in the term sheet. Because a VC can come in and say, "I'll give you $5 million at a 25 million valuation, but I need 3x liquidation with full participation." So it'll kind of be embedded somewhere on the 27th page of your term sheet, and you probably are exhausted by the time you get there. You don't pay attention to it, and that'll screw you over because some of these terms they last until your company goes public. So what that means is all the future investors that come in, they'll want at least those terms or better terms. So all these terms kind of eventually come at the cost of all the common shareholders. So you got to watch out for these things. From a suicidal standpoint, what I can tell you is I'll give you 3 examples that I'm closely familiar with. So one example is there was this founder that has offered a term sheet of I believe it is like $1 million for 50% of the company at the seed stage. The problem with that is once you take an investment at the seed stage and give out 50% of the company away, you pretty much locked yourself from not receiving additional capital from any other investor, because they pretty much know that the VC math does not work at that point. So you want to be careful about how much you dilute yourself before you hit your Series A. The second example is, again, I'm beating up on liquidation preference, so don't screw that up. So I've seen companies make that mistake, so don't do that. The third, something that's nuanced that I've run into is you might find like a Series A VC that also dabbles in the seed stage. And if you take an investment from a VC that is specialized in Series A, but they also dabble in seed stage, and you take money from them, and when you get your Series A, if that VC does not invest in you or does not lead or co-lead or participate in your Series A, it sends a negative signal to the rest of the VC community that, okay, this VC has been with this company since seed and they're not participating in the follow-on rounds, or something is obviously wrong. So your chances of getting that follow-on investment kind of dies down very quickly. So be very careful about who you take the capital from as well. So those are some of the suicidal ones that I've seen happen amongst my customers.
Great. Thank you, Rajesh. Actually,
with
yes,
all of that, and I just want to highlight again that every founder should imagine what his or her ideal investor is, what that investor looks like. Do you want someone that is going to be very hands-on and guide you a lot? Do you want someone that is a little bit more quiet, a little bit more hands-off, and to understand very well the things that that investor insists on or things that aren't important to him or her? Because that relationship really is going to define how you grow your startup, and it's going to be a critical relationship for you to manage and map as you go forward. I know that as founders, it can be very difficult because cash is critical to continuing to grow and be successful, but you don't want to take cash from just anyone. You may want to make sure it's a good fit. There is a lot of money out there. It has to be the right fit for you. And we've all been in that situation where it's like, God, I've only got 6 months of runway left. I'm like burning through this cash so fast. What am I going to do? But just keep the faith, keep faith in yourself, keep faith in the process. Remember everything that you've learned through Newchip and your other learning experiences, and stay really focused on who you want to partner with.
Awesome. Thank you, Kerry. Both of you actually remind me of a question that I heard a lot as well, is how many investors should I have for my round? This is a very good question because we have lead investor and we also have a lot of followers who will follow the lead investor or co-lead investor. So what is there a good, like a magic number, or there's just no limitation on how many investors I want to take? I'm not talking about the crowdfunding, which is a completely different topic, but just in sense of all the normal high net worth accredited investors. What's your what are your suggestions on this?
Mm-hmm.
So from an SEC standpoint, there is a requirement that if you have more than 10,000 participants on your cap table, then you have to be a reporting company. So that's, again, at the high end, you're pretty much an IPO company by the time you've had those many. There is also a new rule that has come out. I'm not 100% sure if it's very specific to CF, but I'm pretty sure it says that if you have more than 500 investors and your revenue is more than $10 million, then you become a reporting company. So you want to watch out for these kind of rules that are coming out. I think the second rule is part of 12G is what they call it. The one way to kind of avoid some of this situation is if you have like an LLC, and within the LLC you have like multiple investors that are part of that syndicate, and if your cap table has only one line item that shows up, you can do that with some SPVs, or there are some syndication that also lets you do that. So those are the ways you can avoid running into these problems. The other challenge is, like, you might have a lot of like what Kerry mentioned. You want to have investors that are really value add. You don't want investor who's given you like a 10K check and is going to be asking you for updates. Tell me what happened every 2 weeks. So it's going to be a lot of time sink on investors or on founders to spend time on investors who are not value add, but they just gave you money because they want to support you. So you want to also be careful about who you bring in addition to any regulatory limits on how many you can have on your cap table. So that's my take. Kerry, anything from your side?
You said that very well, and I agree with all of those points. I know for me personally, I'm a very neat, very organized, very clean person, and I like a cap table to look like that as well. Mm-hmm. And when you have too many investors, it can pose a problem. You want to be highly communicative with your investors. And you want to be able to develop relationships with them, especially at the early stage. And so for me, if you're able to get larger commitments from fewer investors, I think that's more desirable. That's my personal preference. I think it works well for most of the startups with whom I've worked, as well as those that I've mentored. But if, all of us can do that, you can keep track of your own cap table. If it gets to be something that's too unwieldy, then perhaps you should rethink how many investors that you're bringing in.
Yes.
And I guess one more data point I can add is certain VCs, like I would think all VCs, like before they write a big check, they want to know who's on your cap table. They probably want to understand any conflict of interest, what is a KYC, AML situation for these investors. So if you have like 100 investors already on your cap table, you might have to explain who each of them are, how they're contributing to your business. So I know of a customer that is looking to kind of clean up the cap table. So they're looking for ways to make it easy, because when you raise capital, they keep running into these questions. And the easier if it is for them if the cap table was not that big. So that's the other piece you might have to think about from having a large pool of investors.
Yes. Thank you so much for your time today. You guys share a lot of knowledge with our community. We talk about a lot of useful information during this session, and I believe that our audience has learned a lot from you guys. Really appreciate your time and support on behalf of our Newchip startup community. Thank you very much for your contribution. This is the end of our panel discussion. We will see you next time.
Thank you
so much.